Unthinkable chaos looms. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the global banking system is nearing its breaking point, and you won't believe who is behind it and what they are doing to destabilize the world's banking system. Plus, consumers in one country have finally had enough with higher interest rates, and we're seeing deposit flight at a massive level, leaving an entire region of the world, which is also adding to the whole narrative that their banking system is about to come crashing down. And Morgan Stanley makes one of the most outlandish claims ever, but will they be right? And if you're wondering what we're doing in South Korea today, we might have the first real evidence of the mythical soft landing. Plus, we have a sponsor for today's show, GeoVax. They're on the NASDAQ under the symbol GOVX. They're a clinical stage biotech company. Stay tuned to the end of the show to learn more about them. Plus, we're going to show you, just as we do with all of our sponsors, how we think you can trade their stock because it's deep in a supply zone looking to break higher. We think could make a 13% move here in the near future. Also, check out the pinned comment and description for more information. Now, let's head over to Bloomberg, where we picked today's story up with a headline: Korea's early export gains point to recovering global demand. And this is a big deal because right now, policymakers and politicians around the world are praying to the monetary gods that something good will start to happen because they have raised rates, tightened financial conditions so much that they're worried about inflation. Instead, what we're starting to see signs of, they're worried they've gone too far. And now when we see headlines out of this from South Korea, there is perhaps some hope, but hope is being dashed by reality. As daily average shipments for the first 20 days of October increased 8.6% from a year earlier. Of course, you look back to a year earlier, they were quite negative in the first gain sub September last year. And this is a big deal right now because, again, we talk about the global economic recovery, the soft landing that everybody is hoping will happen. And the challenge here is, why would October be a potential interesting month for exports? Well, it's real simple. You got to get them on the ship over to America in time for the holiday season. So you think about this, and we're just looking at more seasonality, as we've talked about, with perhaps back to school and now Christmas, holiday season coming up. I think there is a big push here. The 1 month doesn't change everything. But if we get a series of a few months showing positive gains, well, that will change everything. The increase is a positive indication that world trade is starting to regain strength after a global slowdown. South Korea releases its data earlier than most economies, and due to its key position in the global supply chains and the tech sector, its export figures are watched closely to get an early take on the trajectory of world trade. And what we're more concerned is not about exports, although these are key. We want to see imports, because when domestic demand is increasing, and we know globally it is decreasing, that's where you really see economic revivals begin. And this, again, could be just a 1 month off report. We won't know, at least for a while. In the end, the rebound in chip prices is leading the export rebound. We may see an odd economic situation of high growth, high rates, and high inflation next year. Well, that's not exactly true, because if you think about it, high growth and high inflation, well, they should come together. And as a result of those two, you should get high rates. But what is the one problem with high rates right now? Is they're being artificially manipulated by central bankers. So if we saw central bankers get out of the rate-setting market, we don't actually know where short-term yields were at. And because we don't know where they're at, they're also artificially affecting intermediate and long-term yields. So the notion that the market has got this correct, well, that's not true at all. It only will be time before we find out if central bankers have it right or wrong. Meanwhile, up north, consumer sentiment turns negative in Canada as high rates bite. And so we're finally seeing the first signs where consumers are tired of higher interest rates. They don't like them. They don't want them anymore. And now we'll see what's going on in Canada. And when we look at the Bloomberg Nanos Canadian Confidence Index, a measure of sentiment based on weekly polling, it dropped to 49.5, meaning a level below 50 suggests net negative views about the economy. Its lowest reading since April and compares to 53.1 in early June, this year's peak. The number suggests Canadians are becoming less optimistic about their financial health and wealth, which is closely tied to housing. Now, of course, here's what I want you to understand. When consumer sentiment declines, so does consumer spending. So this is a really big issue here. And usually sentiment leads spending. So the fact that Canadian consumers are feeling less confident does not bode well for the coming months. As this is because Canadian home sales fell for the third straight month in September, as the Bank of Canada's aggressive interest rate hikes continue to keep buyers off the market and will eventually, with some hope, at least this is what central bankers want, cool off the housing market. Of course, we know what happens when you take a pin and prick a giant bubble, which we know now various places around the world are in bubbles, particularly the Canadian housing market. It's only a matter of time. Someday it gets popped, and when it does, and home prices there crumble, you're going to watch consumer confidence there crash to the floor along with their spending. But let's put this to the test. Let's take a look at the University of Michigan. This is a U.S. data of consumer sentiment, and we're going to compare this to 10-year Treasury yields. And what do we know? That there's absolutely no correlation between higher interest rates and consumer confidence at all, because we can just look at the two lines. We see consumer confidence in blue. We see 10-year Treasury yields in red. There's absolutely no correlation at all. The real correlation has to do with inflation. And what happens is consumers become less confident. You see here, confidence starts to come down as inflation goes up. That's what you tend to see. And when inflation is moderate or even tending to decline, well, consumer confidence goes high. And you want to think about, well, why would that happen? Well, because my wages, let's say they're staying static and prices or my wages are outpacing prices, that means I'm happy. That means I have more money to spend. And of course, that's what consumers around the world love to do. Now we look forward to right now, and what do we see? Consumer confidence rising at the same time that inflation started coming down. So there's no mystery here. The issue becomes is not when we go like now, but when we go back to the global financial crisis, you see what's happening, inflation rising, consumer confidence going down, and then all of a sudden what happens, inflation starts to come down, consumer confidence rises, and then all of a sudden the consumers figure out that, wait a minute, crashing consumer prices isn't that good for the economy after all? And it turns out that leads to layoffs, as we made the case over and over. So right now we're kind of in this kind of nirvana period of consumer confidence where consumers are kind of buying into the fact that, hey, I'm still getting raises. Inflation is slowing, things are looking good, until all of a sudden inflation continues to go down. They find out those raises are gone because, of course, their employer needs inflation to pass on higher wages. And then when that's gone, spending goes away along with jobs. But one thing that's also going away is money from one of the biggest countries in this world, and it's putting major stress on the banking system. So I want to start with this as we lead in to our headline story, because it's all important to understand the narrative of what's going on. As Chinese yuan pressured by the biggest capital exodus since 2016. Now, we've made the case before on the show. We've said, look, nobody wants the yuan. It's losing value. And if you're inside China and your currency is losing value, what should you do? Get your money out. And how fast? You should mean yesterday and today, and probably get it out tomorrow too, and get as much of it out of that country as fast as you can. And sure enough, that's exactly what's happening. As China's currency regulator, the State Administration for Foreign Exchange, said on Friday onshore banks sold a net $19.4 billion of foreign currencies to their clients last month, the most since November 2018, the height of the U.S.-China trade war. Banks also sent a net $53.9 billion overseas on behalf of their customers, the biggest monthly outflow since January 2016, shortly after policymakers engineered a depreciation of the currency in August 2015. So you start to see the case here. It makes perfect sense. If you have money in China, currency is losing value, and you have the ability to get it out, you get it out of there. But what do you do with it once it's out? Well, that's where things start to change. The unfavorable interest rate spread between China and the U.S. will likely imply persistent depreciation and outflow pressures in the coming months. So here, imagine this. So you have money in yuan in China. You want to get it out. And where are you going to go? Well, because one option was you could just invest it in Chinese government bonds. But the problem is the central bank's been slightly lowering rates, putting downward pressure on yield. Or you could go over, get some dollars, convert your yuan into dollars, and go buy U.S. Treasury securities, yielding a far higher rate. And so what starts to happen is all of a sudden you get the impression that money is leaving a country. So I want you to just understand money's leaving China, and it's going to go where it can get the highest, safest yield, and that's going to be, of course, the U.S. Treasury bond market. So I want you to keep in mind now, the banking system in China, we've talked about this before. What does it need? It needs money. What is the problem? It's flowing into the U.S. commercial banking system. But it's not just China. It's money from all over the world, and that's causing big problems. As China's sovereign wealth fund buys up ETF shares and the market boost. Now, we've talked about this before. It's important to understand that equity prices don't just magically go up. And I know a lot of people think they do, but they don't. It takes people buying stocks to higher and higher prices. So one of the challenges is when you have overinflated equity prices and you have a curtailing of money in the global economy, or in the case of China, money leaving the country, well, what happens is you don't have enough buyers to sustain equity prices, so they come down. And then all of a sudden you get calls from the government to prop up the equity market, because what else is really key in consumer confidence that leads to consumer spending? Well, it's high equity prices. And here we can see that they bought an undisclosed amount of ETFs and vowed to keep increasing ETF holdings in the future. This according to a company statement. Earlier this month, the sovereign fund said it raised stakes in the nation's big four lenders. Now keep in mind, what's going on. We talk about how the global banking system is on the brink. You haven't even gotten to the who's behind this. But just think in China, money's leaving the country, and now you have the sovereign wealth fund come in and say, hey, we got to prop up these banks, because if we don't prop their stock price up and the whole property market collapses, what happens to banks? They go poof, and next thing you know, it spreads like wildfire through the global economy and the global banking system. It added it would continue purchases of state-run bank stocks over the next 6 months, making us wonder what happens after that. And here we can finally start as we move into our lead story today. U.S. Treasuries are at 5%, and this coming from Morgan Stanley. They're saying a buy at 5%. Meanwhile, most U.S. investors say the rates are going much higher, but Morgan Stanley's starting to say, wait a minute, we think this is a great opportunity. And maybe part of that reason is the exodus of money coming out of China. Well, it's going to get parked somewhere. And these people aren't just going to go speculate on stocks. Now, granted, some of the money will flow into the U.S. equity market, but a bunch of it is going to flow into the bond market, which again has a higher spread on the yield compared to Chinese bonds, and you've got the safety and security, at least of the U.S. government. Those will be great levels to get longer in your portfolio from a duration perspective, and this under current conditions. The co-head of the broad markets fixed income team there in Boston for Morgan Stanley will be superbly in that overshoot category from the firm's fair value level for treasuries should yields breach 5%. And sure enough, what did we see? This happened. And while they're eyeing 5% as a decent entry point, he also has a steeper trade among his favorite bets. Morgan Stanley Investments positioned for the yield curve between the 2- and 10-year bonds to steepen. Now, of course, many of you know we love to talk about the yield curve on the show. But one thing I want you to start to understand is set the stage here. Money leaving China, getting converted likely a bunch of it to dollars. Those dollars going into U.S. Treasuries because dollars don't pay interest. So I want you to start to see as the Fed continues to raise rates, what are we seeing around the rest of the world? Is the global economy slow? Central bankers are going to pause, eventually start to cut rates. And what is this going to do? It's going to draw money where? To U.S. Treasuries, into the U.S. commercial banking system, and that's not a good thing at all. The trade has paid off as a 10-year bond yield surged, narrowing the negative spread with a 2-year note for more than 100 basis points. We definitely think it will flip, meaning he thinks yields will fall back to a positive spread, but I think the timeline for that is going to be a little bit longer. The firm now thinks the Fed may only cut rates in the end of 2024 or at the start of 2025. Of course, we know there's no way they're going to get to the end of 2024 without cutting rates. We know the yield curve is likely to steepen, but it's going to be the kind of steepening that the market's not prepared prepared for, which means that yields actually come down. Of course, we can make the case here of why Morgan Stanley may be right. Well, whether they've got the timing right is another issue, but here we can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That's shown in blue, and anytime it's above that horizontal black line, it means on net, banks are tightening standards, and what that means is simply originating fewer loans, creating less money into the economy, and that's critical because if you want the economy to grow, you got to have money. And now what do we see here? The yield curve in red. And what happens when banks tighten standards, the curve steepens, and it steepens when rates go down. So here's what I want you to understand is when banks curtail lending, less money is created in the economy, but you need a certain amount of money to maintain asset prices, pay on the debt, and maintain growth. So what happens eventually in the monetary system? Rates get driven down, not by investors, just by the fact that the system gets starved of money. But right now, one of the problems is everybody is short the long bond, and there's some reasons for that we'll get to in a bit, and why it has everything to do with the fact that the global banking system is on the brink of collapse. So here we can see the yield curve rising. So as banks tighten standards, we note that yields tend to fall. We see that here during the global financial crisis, and it makes sense because how do you get people to borrow? How do you maintain asset prices? It certainly isn't higher yields, it's lower yields. So what do we see now? A steepening because rates are rising, but eventually that's going to flip. We know banks are likely to continue to tighten lending standards, and that means the curve starts to steepen, rates start to come down, and everybody has got it wrong. And now we start to see that Treasury 10-year yield breaches at 5%. This happened in overnight trading for the first time since 2007. And what immediately followed is rates came crumbling down. Now, one of the challenges here, and I want you to look at this part of the headline, it says Fed interest rate hikes, big deal, and swelling supply erode bond prices. And see, there's this long-term view that the U.S. government can't continue to issue a lot of debt. And the problem is a lot of people don't understand how the global financial system works. They don't understand the monetary system because when the government borrows a lot of money, it competes with the private industry in the economy for money. So the larger the deficits the government runs, the more money it needs. And on this case, we have higher interest rates on top of it, attracting money from all over the world. And so the evidence that shows that the more government debt leads to lower rates has everything to do with this chart. Because in fact, as the U.S. government issues more debt, this blue line now shown inverted, what happens is rates fall over time. And there's certain periods where they rise a little bit. And what happens? They come crashing down because what's happening here is, again, the U.S. government's intervening into the economy, pulling out all this money and leaving less money for growth. And that means rates must come down. So the notion here that we're issuing too much debt might be a personal issue. You may have an issue with that from a political standpoint and say, look, this is not sustainable. And I have no problem with that. I agree with that. I'm not arguing that. And what I'm arguing is the fact that investors think that higher or more debt leads to higher yields. Well, why now? If this was going to happen, it should have happened eons ago. And certainly enough, what we're about to see is a global banking system come crumbling down. As we turn back to Morgan Stanley, we see they explain the real drivers behind the rout in treasuries. They say explanations for the recent spike in yields, the treasury curve bear steepening, which is going to turn into a bull steepener soon enough, and increased term premiums include technical drivers like U.S. Treasury market supply, which has absolutely no bearing on things, investor positioning adjustments, CTA selling, which we showed you on Sunday, are done, and agency mortgage-backed securities related negative convexity flows, and more fundamental drivers. Look, the bottom line here is what the issue is with the global banking system is money is getting pulled out of the economy. That is the issue. It's getting sucked into all these treasuries because the yields on them are too attractive. They're too high relative to the other parts of the world. And as you pull money out of the global economy into one part of the world and a part that doesn't generate any economic growth, you starve the banking system. That's why we're seeing this in China. We still look at the U.S. banks. What did we know on Friday's show? They're still insolvent. They're still borrowing money from the government. They are all small and mid-sized regional banks here are dangerous. So what happens in the global economy is you need a circulation of money. It has to continue to flow. And so the issue is who's about to break the global banking system? It's the Fed. By raising rates relatively high compared to other central bankers, they're causing money around the world to pool into the U.S. commercial banking system, into U.S. Treasuries, where it sits idle. And next thing you know, because banks aren't creating enough new money on net, which we showed you on Saturday's show, banks are starting to see commercial industrial loan growth turn negative, what means at some point the banks are starved of cash, and next thing you know, as are consumers, as are businesses, and next thing you know, you start to get delinquencies turn into defaults, and the whole system crashes down, and we can blame on one person, and that, my friends, is the Federal Reserve. So now you know why we are on the brink of a major collapse of the global banking system. But one thing we are super bullish about, and that is our sponsors for today's show, and that is GeoVax. They are innovations in immunology. They're a clinical stage biotech company developing novel therapies and vaccines for cancers and many of the world's most threatening infectious diseases. You can find them on the NASDAQ under the symbol GOVX, and we're about to show you. Just hang tight, because I want to introduce you to the company and then show you a chart setup. It's super easy. Wait till you see the supply zone and a potential 13% move higher in their price. As we said, they're a clinical stage biotech company committed to developing safe and effective vaccines and immunotherapies against cancers and infectious diseases. They've got a product pipeline which includes ongoing human clinical trials for COVID-19 and advanced head and neck cancer. Their proprietary technology offers a well-validated platform approach that is suited for use against a wide range of cancers and infectious diseases with significant advantages versus competitive technologies. And their business strategy is to advance their products through regulatory registration while also seeking partnership or licensing arrangements that might otherwise maximize the value to their shareholders. And one thing that we think is going to maximize value to your trading account is their stock setup. So I want you to look here over the last 6 months. You see we have these supply zones, these purple lines. And you'll notice this top one is where the sellers are at. So when the price gets up here around the 60-cent range, that's where you see sellers emerge. But look what happens down here around this 51 to 52 cent range, maybe as low as 50 cents, is that's where buyers come in. And so notably what happens, price pulls down into the supply zone, buyers show up, and it rises quickly right back into the sell zone. It came back down again, buyers stepped in, price jumped up, and once again, sellers emerge, and now it's back here in the supply zone, and that's our case, a 13% move from its current price at the time of recording all the way up to around 60 cents. Well, that would realize a 13% move to the upside, symbol on the NASDAQ, GOVX. Now, GeoVax has received notice of allowance for their Marburg vaccine patent. In a recent presentation, data from non-human primate studies demonstrated that immunization with GeoVax's vaccine candidate, GeoMM01, conferred 80% survival after a lethal dose of the Marburg virus. Their CEO, David Dodd, said, while our focus on development priorities continue to be our next generation COVID-19 vaccine and cancer immunotherapy programs, developing vaccines against lethal hemorrhagic fever viruses represents our commitment to addressing highly fatal endemic threats throughout the world. And one thing we think is going to be a catalyst and bringing this company to the limelight is a big move in their stock price. Again, we see this moving 13% in the near-term future. And you can see as we zoom in here to the 90-day chart, we look at the supply zones, and what do we see? Momentum starting to bottom out. The MACD looking to bottom here. The RSI came off slightly oversold territory and looking to move higher. And what do you see? Gets in the supply zone, shoots higher. Supply zone, shoots higher. Supply zone, next direction, you can guess, likely to be higher. Again, symbol GOVX on the NASDAQ. They've also received notice of allowance for their HIV vaccine patent. What we see from their CEO, our development priorities continue to be their COVID-19 vaccine, but currently in phase 2 clinical trials in our cancer immunotherapy program. What they have is earlier this year, data was presented from a clinical study of a combination HIV therapy that included GeoVax HIV vaccine candidate, MVA62B. The goal of the trial was to reduce or eliminate viral replication in the absence of antiviral medications in HIV positive individuals, what they call a functional cure, something that we think will be a functional cure to the doldrums of your trading account would be GeoVax's stock. Here you can see the volume profile line now, zooming in on the 30-day, right at around 53 cents. You can see buyers coming in all the way down here between roughly 51 and 53 cents. A break above that would likely send the stock price, based on prior movements, all the way up about 13%. And we think that is a tremendous opportunity. As with any company we feature on our show, be sure to do your own research before placing any trades, because you're under no obligation to purchase their stock. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.